Hello and welcome back to the channel. My name is Zach Collins and this financial education. Today I'll be talking about debt. Now in this economy we've seen massive high inflation. Jobs are being cut or wages are just being kept flat. This has caused a lot of people to experience a cost of living crisis and taking out debt to help fund their lifestyle. Well, I can't really help with that. Hopefully I can give you two different strategies that people use to pay down their debt and maximize their wealth and well-being. These two strategies are known as the Snowball and the Avalanche methods. The Snowball method, as the name suggests, is where you start with something small and over time you work your way to get bigger and bigger. Before I continue, I do just want to emphasize that with both of these strategies, they both have the same minimum requirement. That is, you must continue to pay these debts. Do not let them go into default. Make sure you continue to pay the minimum on all the debts you have. It's just about how you pay off these debts and which ones you prioritize that differentiates them. Okay, getting back into it. So with the Snowball, you start with the smallest debt value you have. Let's say you get a $2,000 credit card and a $20,000 car loan, and then a $200,000 mortgage. You start off by paying down the credit card first because it has the smallest balance remaining. You then focus on the car loan, finally the mortgage. The principle, the Snowball and Avalanche methods, is that you make sure you continue to pay the same amount even once all the debt is gone. You just focus on a different debt. Rather than just using arbitrary numbers, let's use a bit more of an understandable example. Using the same credit numbers I mentioned before. Let's say you have $2,000 per month that you can use to pay down these debts. Let's assume that the minimum payment on the credit card is $100. The car loan is $500 and the mortgage is $1,000. This means that just paying the minimum amount on all these loans is $1,600, leaving you $400 per month to choose which debt you focus on. If you use the spare $400 on the credit card, it will then take you 5 months of $400 per month to pay off your $2,000 debt. From month 6 onwards, you will then have an extra $500 per month to pay down the car loan, as you have your initial spare $400 plus the $100 you were spending on that credit card. This means with your extra $500, it will take you 40 months to pay off that the $20,000 car loan. 40 months equates to about 3 years and 4 months. This means the first 2 debt payments will be fully wiped in less than 4 years, just leaving you with that big mortgage left. You will then have an extra $1,000 per month to focus on the mortgage, and it will more than half the amount of time left on that loan as you're paying double the minimum required payment. The gain by using the Snowball debt strategy is that mentally you know you have less and less debt. You start off with 3 distinct loans. You've now paid off 2 of them and you've only got 1 left. The next strategy that I go into, Avalanche, it does not necessarily give you the exact same peace of mind. Now, before I move on, what I really need to emphasize here is that the numbers I'm using, they're arbitrary. And they basically all assume that you're paying interest only. If you were paying principal as well, you would already be paying down the loan each payment you're making, and these extra payments are just speeding up the process. The 4 years I said it would take to pay off the credit card and the car loan would actually be closer to 2 or 3 if you're already paying P&I. The Avalanche method is where instead of focusing on a dollar value, you focus instead on the interest rate of that debt. So using the 3 different types of loans that I mentioned before, credit card tends to have the highest interest rate because they are unsecured debt. A car loan would be next as it's secured. The asset does depreciate and it's a non-essential good. Finally, a home loan tends to have the lowest interest rate because it's secured against an asset that tends to appreciate in value, meaning it is less risky for the lender and everyone needs somewhere to live. If we were to do an example using the same dollar amounts as we did before, we would actually use the exact same order of operations. Credit card debt, then car loan, then home loan. Because as I said before, that tends to be the order of the highest interest rate. If we changed up the dollar amounts and now the car loan is $2,000 and the credit card is $20,000 of debt, we would be focusing on the credit card first, even though the car loan has a smaller dollar balance. The reason it's called Avalanche is because you are paying the highest interest first. You knock out the highest amount and it then cascades down to the lower interest rates once it's fully paid off. From a mathematically point of view, paying off a high interest rate is going to result in a higher benefit than just paying off the lower balance. And this can be explained using some maths. Let's say we have a $2,000 debt at 15% interest, $2,000 at 10%, and $2,000 at 5%. So it's costing me $300 per year to have debt 1, $200 for debt 2, $100 for debt 3. If you have $2,000 to spare in a savings account and decide to pay off one debt. If you choose to pay off debt 3 first, great, you save $100 per annum in interest, which is honestly, it's great. But you're still paying $500 each year for the other two. If you instead chose debt 1, you'd be saving $300, and it means the other two, you're only paying $300 in expenses. This means you're benefiting the difference, which is $200 per year. Now, this $200 bonus savings means you can then roll it into the other ones, paying the amount faster and compounding the rate of debt pay down. In economics, there's this idea called opportunity cost. If I did X, what is the cost of not doing Y? Using the debt pay down, whether you choose option 1 or 2, you still have some benefit. You get a guaranteed benefit of 5% or a guaranteed benefit of 15%. Honestly, both are great outcomes. However, the opportunity cost is the difference in the return between the two. If you chose the 5%, your opportunity cost is 10%. So that's the difference between 5 and 15%. Every dollar you spend is costing you 10 cents, doing X over Y. If instead you chose the 15% debt, the difference is minus 10%. That means you're making an extra 10 cents for every dollar using that strategy. Everything I've said today, it just looks at the straight debt balance and the debt interest rates. What you need to be mindful with your specific scenario is that some loan types have fees and costs paying them out early. So you need to be mindful of that and whether it's actually beneficial to do this. Many types of debt also have monthly or annual fees or fees per payment. This again needs to be factored into your calculations around which one you need to focus on. Just because the interest rate is the highest or the balance of the debt is the lowest does not mean that using either of those two methods, any specific debt is the one you need to be focusing on first. Paying down debt is a great way to turn your life around and to start building wealth. Just make sure you sit down first. Look at every debt you have, what the fees are, and what actually costs you each month, and whether it makes sense to pay it out or not. Only you and the specific loan contract can determine that. Hopefully, I've been able to give you guys a better understanding of the different types of debt repayment strategies that you can target and use and mentally get yourself stronger. If you have any more questions, please feel free to drop a comment down below. I will answer if I can. Thank you so much for watching, and I'll see you guys on the next one.